All right, can everybody hear me now? I don't know why it's doing that. It's done that 2 webinars in a row. Can everybody hear me okay? I have no idea, folks, why it does that. It's done that 2 webinars in a row, and that is why I kind of did the sign language thing to you. Who do we have on the call here? We have a pretty good group on the call. Of course, we have my guy, David. We have Bill out in North Carolina. We have my guy, Sal, who's always on these. We have my guy, Greg. And let's see. Yeah, we have about 20 other folks. Hey, absolutely thrilled to have you on. Happy Friday Eve, as I like to say. This is a pretty dry topic, but I promise we're going to make this fun. And to be quite straightforward with you, I've been in the business for a long time, about 25 years now, and there is nothing more complicated than discussing taxes. Why is that? It's not that I don't understand taxes. I actually do pretty well. It's just that the tax code, it's 75,000 pages long. The US tax code is. So how do I talk about that within an hour period of time so that everybody understands it without inundating you on a bunch of crap, so to speak? Very technical term here. Now, before we go into this, which is going to be a very applicable, a very practical webinar, this is based off my experience of many years ago sitting with clients and having them put down their tax form, their 1040, and say, hey, Charlie, can you help me with this or help me with that? And you look at it and it's like it's Greek. Can anybody connect with me on that? Can anybody connect with sitting with a client and having them pull out their tax form and saying, hey, can you tell me about this and tell me about that? And you're just kind of deer in the headlight. Comment if you have had that experience before, because I have, and I learned a long time ago to understand the 1040. So that's what we're going to talk about as far as practical tips and tricks for uncovering opportunities on the 1040. Now, before I go there, I want to make a few announcements. Number one, thank you to those folks, those Athene producers that came into Des Moines last week. As many of you know, I invited some folks that have produced with Athene, and they came into Des Moines last week to attend the Athene meeting. I got to, of course, meet up with everybody. Absolutely thrilled to see all of you face to face versus this just virtual thing that we've been in for a couple of years now. So thank you, fine folks, for coming into Athene. And folks, we're going to do a meeting here, just a CG Financial Group meeting here in Des Moines. And don't throw up. Des Moines not that bad. I think many people would concur. And we'll have fun. I'll do some barbecue. I'm thinking we'll go out and shoot some high-powered rifles. If you're into that thing, I am into that thing. So we'll have some fun. I'm looking at fall or maybe at the latest next spring, which is crazy to think about. That's a long ways away. So I'm looking at fall, obviously. It's not going to be winter, I'm happy to say. All right, so that's the first one. The second one is Athene and American Equity. They have recently repriced their GLWB products, and they're absolutely killing it. So if you have a client that needs guaranteed lifetime income, their products are the top of the charts right now. When you call me and say, Charlie, I need an illustration, who is going to give me the best income for this client at this point in time? Maybe it's a year from now, maybe it's 5 years from now, maybe it's 10 years from now. I run you the Annuities Genius reports. I run you the Annuity Rate Watch reports. I come back to you and say, hey, based off the numbers, this is the best product based off of the numbers. Now, what about the non-numbers part? That's where I go into more of the qualitative stuff than the quantitative stuff. But I tell you, quantitatively, qualitatively, Athene and American Equity are at the top of the charts right now. You will never be out product when you work with CG Financial Group because of the technology and because I'm obsessed with learning, understanding, and helping you with these products. Last thing, third thing here is 3.5% for 2 years, pending state availability. I'm not sure what state everybody is in here. I have some pretty good ideas, but a lot of strangers on the call, but 3.5% for 2 years currently. And the average certificate of deposit 5-year is around 50 basis points now. It's skyrocketed. It's now at 50 basis points on the average 5-year CD. Well, you can offer a client for 2 years, 3.5%. For 5 years, we are now over 4% guarantee. And if you got my email, which you probably did, which is why you're on this webinar, check out the annuity laddering video. It really, I think, does a good job. Not that I did such a wonderful job. Well, I did do a good job, heck, but in articulating the impact of annuity ladders, for instance. So check that out. Okay, so let's get into it right here. First and foremost, I will ask you fine folks the question, whether it's in the chat pane or the Q&A pane down below. Type this out. What do you hope to get out of this call today? What do you hope to get out of this call today? Because the invite was fairly generic, understanding the 1040 as well as some tips. What does that mean though? What does tips mean? What does understanding the 1040? So folks, what do you hope to get out of this call as we transition into our first slide here? What do you hope to get out of this call? I want to make sure I hit the mark. We have a quiet group today, I can tell. What do you guys and gals hope to get out of this call? I want to see almost everybody, well, ideally everybody, comment on this. What do you hope to get out of this call? Because make no mistake, folks, this is going to be a participatory part or a participatory call where I'm going to ask you a lot of questions here. Ideas, cool. Way to be specific, Ray. Ideas. What else? I'm just kidding you, Ray. Understanding the 1040. Well, yeah, I think you've come to the right place here. And the 1040 here, the 1040 is, that's the tax return, right? Some financial tips for my clients, ideas, 1040 refresher. Awesome. So the 1040, the reason it needs refreshing is because it's complicated. That is the tax return, right? If you can just have one form from your clients, it should be the 1040 because that's the comprehensive overview of everything. But what's complicated about the 1040 is you have other schedules that feed into the 1040. For instance, the Schedule B. The Schedule B is where like your 1099 for dividends and interest feeds into, right? So when a client gets a 1099 from an insurance company for interest or a bank, where does that go? That goes on the Schedule B. Well, then the Schedule B contents or the summary feeds into the 1040, right? So you have that. You have the Schedule D, which is capital gains. You also have the Schedule C, which is, folks, what's the Schedule C? I bet a majority of you know exactly what the Schedule C is. What is the Schedule C? What does that form indicate? Profits or losses from what? What is the Schedule C? Business. That's most of us, right? So you have this 1040 and all of these forms with all of your income as well as deductions feed into the 1040. So you have all of these schedules. I'm a Schedule C company, right? So me as an LLC, my profits and losses are on the Schedule C, but that doesn't directly feed into the 1040. It feeds into the Schedule 1, and the Schedule 1 then feeds into the 1040 along with a bunch of other stuff. So very complicated stuff if we want it to be complicated, but that's what we're going to do today. We're going to simplify this and I'm going to explain everything to you. Most importantly, the opportunities here. Now, question. Here are the 2022 tax brackets. In the white, it's the income tax brackets. In the green, and then I'm going to give you a practical case study that I just ran into a few weeks ago. Luckily, I knew the answer. So my question is are these rates, so if one is in the 24% bracket, is that effective or is it marginal? Is it effective or is it marginal? So that 24% bracket, is that the effective bracket or is it the marginal bracket? And then I'm going to explain what I mean by that and why I'm surprised that not more people know this. Is that effective or is that marginal? So if you're in the 24% tax bracket, is that effective or is it marginal? That's marginal. A lot of people don't realize that. A lot of consumers don't realize this. I know you guys and gals probably do, but I'm surprised with how many consumers don't realize that if they make, so take the single filer over here on the left, right? So if one makes $100,000, oh, I'm in the 24% tax bracket. So my tax bill is going to be $24,000, not including exclusions, credits, all that stuff. That's not true, right? I'm surprised with how few people don't realize, no, 0 to $10,275, you're taxed 10%. Then 12% on the next, $31,000, et cetera, et cetera. So that's what they mean by marginal tax rates. Over on the right-hand side, you have the tax brackets for capital gains and qualified dividends. What's the difference between an ordinary dividend and a qualified dividend? There are differences, right? You can have dividends that are paid to you by owning a company stock, but because you did not own that company stock long enough, it's an ordinary dividend, taxed at what rate? What rate is ordinary dividends taxed at, folks? Then I'm going to give you the case study here real briefly. Then we're going to get into the meat. What is ordinary dividends taxed at? What tax rate are ordinary dividends taxed at? That's right. Income, taxed as income, right? A qualified dividend, however, is not taxed as income. Qualified dividends are taxed like what you see over on the right-hand side here. What makes a qualified dividend? A qualified dividend, it gets technical, but you basically have to own the stock over a 60-day period of time within a 121-day period of time, which I won't go into, ex-dividend dates and all that stuff. But the point is over on the right-hand side, I try to make it kind of line up as much as I could with, okay, if you're in the income tax bracket over on the left, what capital gains rate as well as qualified dividend rate are you going to experience? And as you can see here, the first two tax brackets there. And what I've done here is I've jumped to the end of the 1040. Then we're going to come back around, and I'm doing this for a reason here. What determines your actual tax bill is this right here at the end of that 1040, after you have the total amount of taxation, the taxable income, right? You plug in the taxable income here, and that's what determines your tax bill. Now, back to the capital gains here. So if you're in the first two brackets from a capital gain standpoint, or from an income tax standpoint, you pay 0% on capital gains. And I've run into a lot of clients before that were surprised at this. I thought I had to pay 15% on my capital gains. No, you're making $40,000 per year. You don't have to pay anything on capital gains, right? But then it kind of gets a little funky there. The 15% capital gains bracket goes down to the fifth tax bracket over on the left there, but it's not a perfect overlap there, right? Because technically the 20% starts at unmarried, 459,000, to where the single filers, it's not a perfect overlap there. But here's the case study. So I met with a client. And this client who's actually given me $750,000. This client had said, I'm selling a house. And she makes $40,000 per year. She's single. She has a boyfriend, not married, not filing jointly, obviously. $40,000 per year. That is her taxable income. This is not adjusted gross income that determines your tax rate. It is taxable income at the end of all of this. Not adjusted gross income, but taxable income, which we're going to talk about the difference there. So she is in the tax bracket of 12%, right? She sells a house for $750,000. She's been there for at least 2 years. Folks, a little bit on real estate here. If you are single, the exclusion amount for real estate sales is $250,000. As long as you have lived, and my goal is to make you dangerous on this stuff. So when you're talking with a client, lot of real estate stuff going on here, right? In our world, people are selling houses for crazy amounts. If you're single, there is a $250,000 exclusion in the gain, as long as you have lived there for at least 2 out of the last 5 years. 2 out of the last 5 years. So what does that mean? If she sells a house for $750,000, she's single. If she was married, the exclusion is $500,000, just so you guys and gals know. So then what is her tax liability? How much gain is she going to be taxed on? How much gain is she going to be taxed on, folks? In the example that I just threw out there. She's single, sold the house for $750,000. I should clarify, above her cost basis. How much of that gain is going to be taxed? The answer to that question is $500,000. That's right. So if she's taxed on $500,000, and what type of tax is that? What type of tax is that? It's the sale of her home. What type of tax is that, folks? Are we looking at the left-hand side or the right-hand side? What tax is it? Is it income tax? Is it capital gains tax? Is it dividend tax? What is the sale of a home? What type of tax is it? That's right. That's a capital gains tax. Okay, but yet, as we're about to see on the 1040, capital gains adds to adjusted gross income, right? Capital gains adds to adjusted gross income. By the way, folks, think about this. Her capital gains of $500,000 adds to her adjusted gross income. Think about her Social Security next year. She's 73 years old. Think about her Social Security payments next year. Think about her IRMA, right? Her earnings when it comes to Medicare, how much she pays for Medicare. What's going to happen next year? Nothing's going to happen next year. But what's going to happen the year following? Medicare goes in 2 years, right? Let me know if you have questions on that. We'll talk a little bit more about that. So what does that $500,000 do to her tax bill? What does that do? What bracket is she in from an income tax standpoint? She just sold a house for $500,000. She's going to be taxed on $500,000, sold it for like $900,000. But what she's going to be taxed on as capital gains is $500,000. So what income tax bracket is she in? She asked me this question. What income tax bracket is she in? This is important you answer this one because I want to see if you guys are tracking with me here. David, you know this. We talked about this a week ago. That's not correct. David is correct. She is still in the 12% income tax bracket. So what you're going to see here is down at the bottom of our 1040. This is where it gets confusing. Down at the bottom of the 1040, she's going to have income of $540,000, right? Taxable income of $540,000. But that doesn't mean that she's going to be in the 37% tax bracket when it comes to income. No, because what happens is those two chunks of taxation, capital gains over here, and then you have income over here, it's separated out. So what does that mean? It means that her income tax bill is going to be based off of her $40,000 in income, right? Which is the 12% tax bracket. Well, okay, then what is that additional $500,000 going to be taxed on? So think of it as like LIFO, right? First, it's the income tax. And then stacked on top of that income tax comes the treatment of the capital gains. And that capital gains, she's going to be taxed at 20%. Is it just 20%? Is it just 20%? Or is there something additional there? Let's summarize as those answers are coming in. High capital gains cannot increase the income tax bracket that you are in. High capital, you could have $1 gazillion in capital gains. It cannot increase the high income tax bracket that you're in. However, if you're making $1 gazillion in income, can it increase? Will it increase your capital gains rate? Absolutely. So what you have here is a sequence: income, then capital gains tax. Capital gains tax can't affect your income tax rate. But Charlie, I'm confused because you just said that capital gain increases the adjusted gross income. It does indeed, but that doesn't mean that it increases the income tax bracket. That's a very confusing topic that I hope I clarified there, but you will have real estate issues here with a lot of clients coming up here. So this is we're going to get into the actual 1040 here in a bit, but this is what the 1040 does. You have at the very top, you have total income. What makes up total income on the 1040? This is just my visual before we get more simplified here. That's your W-2 earnings. At the very top, it is what are your wages from W-2? Many of us are not W-2 employees, right? But then, like I said, those other forms, taxable interest and dividends, right? If you have dividends from a stock or a certificate of deposit, that's a field right there that is in the total income or the income section of the 1040. You also have IRA and pension distributions that add to that total income. So what you have here is the green boxes are the fields, or nouns, I should say. The red boxes are actions that are taken to get to the next noun, if that makes sense. So you have total income, you have capital gains that again are fed in from the Schedule D, you have interest and dividends from the Schedule B, and then you have other stuff. You have this funky thing called the Schedule 1. The Schedule 1 also feeds into total income. And that Schedule 1, which is also, I would say the 1040 and the Schedule 1 are the two most important forms that I always ask for when I'm talking anything having to do with taxes when it comes to consumers. Why? Because the Schedule 1 has, if they own a business, for instance, that income, if they have gained or lost money from that business, that is fed into that total income on the 1040 via the Schedule 1, which gets feeds from the Schedule C or the Schedule E if they have real estate rental income, or Schedule F, a lot of farmers here in Iowa. So you can see that that part of Schedule 1 feeds into the total income, but there's another part to Schedule 1, and that's adjustments. And this Schedule 1, this part, this second half of the Schedule 1 has important stuff for us. Like, what about health savings accounts? Mrs. Client, you have a high deductible health plan, but you don't have a health savings account. What about simple IRA deduction, simple SEP? What about traditional IRA deductions that are reflected on that Schedule 1? And you can see here, are there phase outs? Meaning that if their adjusted gross income that we're going to get to in a bit is above a certain level, do those particular deductions, because this box right here, this little white box, we want that sucker to be as big as possible, right? Because as it trickles down, what is the bottom line point to all of this? We want that bottom box, the tax liability, to be as small as possible. So therefore, we want our top Schedule 1 box to be as small as possible. We want our lower Schedule 1 box as large as possible. Now, what is unique? What is unique? Here's a very tricky question. What is unique about what is in this Schedule 1 right here? I'm going to use my pointer thing here. What is unique about, let's see, let's use a pointer here. Let's do this. What is unique about this one? Say like, you know what, I itemize my deductions and I have, let's see, as low as possible unless you're applying for a mortgage. That's true, Sal. So what is cool about this deduction right here, deductions that are in here, and say home mortgage interest? What is unique about this versus home mortgage interest, which home mortgage interest actually takes place down here? What is unique? What is important? What is a cool trait about this white box up here versus something that takes place down here? What makes this box cool? If you have deductions, a lot of deductions in this box right here, and we'll get into many more deductions. What is so great about these deductions? Here's what's great, Sal, absolutely. They are above the line deductions. That's what they are. So that line there, that black line, I did that for a reason. Above the line deductions say, hey, you are going to get these deductions whether you take this route right here, because you hit a crossroads, right? You hit a branch in the road, and that branch in the road is, do you, which I'm going to check that out. Do you have further deductions against your adjusted gross income based off of the standard deduction, which is just a set amount, right? For a married couple, $25,900. For many of our clients who are over age 65, add on $1,400 a piece for them, right? So $2,800 plus $25,900, $27,000 and $28,700, right? So they choose is $28,700 better than itemized deductions. You better have a heck of a lot of deductions, right? Almost $30,000 in order for you to take this branch in the road over here. That's a Tax Cuts and Jobs Act, right? The Tax Cuts and Jobs Act got rid of a lot of the appeal of these over here, because this is going to be bigger in most cases, regardless of how much you try to fluff up. Not that you would do this, regardless of how much you try to fluff up the numbers over here. But what's beautiful about these deductions versus, I'm going to go down a list of itemized deductions here. Itemized deduction. You know what? I'm not going to do that. That could get really messy. But one itemized deduction is health expenses. Health expenses, as long as they're over 7.5% of your adjusted gross income, right? To the extent that it's over 7.5% of your adjusted gross income. You better have a ton of those to equal more than $30,000. Well, these deductions up here say, you know what? Whether you're going this route or this route over here, because it's above the line, above that adjusted gross income, they're kind of cool. So that's above the line, that's below the line right there. And now let's go into the 1040. Any questions so far? We're going to get nitty gritty here on the 1040, and we're going to talk about opportunities. Long-term care folks on the phone. Is a long-term care deduction above the line or below the line? So you have a long-term care policy and it's $3,000 a year. Is that deduction, because you can deduct a chunk of that, is that above the line or is it below the line? And how do we know? How do we identify an opportunity here? Well, we're going to talk about that part. Is it above the line or is it below the line? It depends. It depends, right? Long-term care and health insurance deductions are below the line for a person. So for me, I'm not self-employed, nothing. Well, I am, but hypothetically, let's say I'm not self-employed. I go out and I buy a long-term care policy. That's a below the line deduction, which means that I don't get to deduct anything unless I have medical expenses above and beyond 7.5% of my adjusted gross income. Now, what if you are a self-employed person? So you're talking with a client and they are self-employed. Is that deduction above the line or below the line? The answer to that question is it's above the line. It's above the line as a business expense is what it is. So that will feed through on, do I have it on here? Self-employment insurance. Line 17 on the Schedule 1. So that feeds through above the line there. Now we're going to talk a little bit more into detail about how much, if you're a self-employed person, how much can you deduct when it comes to long-term care. But my point here so far is it's a beautiful thing. If you're not taking advantage of self-employed folks and the ability to deduct a chunk of their long-term care premiums, you should be. All right, so in the end, you have tax rates. It's multiplied by tax rates after the taxable income, regardless of what side you're on, and then less tax credits. What makes a tax credit so cool versus a deduction? What makes a tax credit so cool versus a deduction? Come on. Your clients don't know this. Your clients don't know this. That's right. If you have a deduction, up here, so you have $100,000 in income. And if you have a deduction of $1,000, that's $99,000 in income. Well, after the tax bracket and everything, that may be that your $1,000 only reduced your tax bill by like $300, right? Well, what a tax credit is after the taxes are applied. So the tax rate, so you have the tax liability or the taxable income multiplied by the tax rate, but then it reduces the ultimate tax liability dollar for dollar. So if I'm in the 30%, to simplify, if I'm in the 30% tax bracket, a deduction of $1,000 is kind of equivalent to $300, right? To where a credit of $1,000, that's $1,000 less of a tax bill, $1,000 less of a tax bill. So that's what makes credit so good. So here is the 1040. Here's the top part of the 1040, the simple stuff, your name, all that other stuff. It's the bottom part that we want to go into here. So this is where I'm going to click through this and just, you know, I've used the 1040s a lot in my past. I've also looked at what, you know, some carriers have as far as like 1040 overlays that I'm more than happy to share with you fine folks. I have kind of taken the best of all of them, but also added my own ideas here. So number one is, are there dependents? Are there dependents? If there are dependents, how old are those dependents, right? Are they aware that they could put away, what is it? Is it 15,000? What's a 529 limit this year? Is it 15 or 16,000? I don't recall. The years are blowing by so fast. So number one, how old are those dependents? Are they going to college? What about a 529 plan? What about an index universal life insurance policy, or a whole life policy, which is great for funding college, right? So when you look at that 1040, do they have any dependents there? What about double E bonds or I bonds? I do have to say this. I bought $40,000 in I bonds recently, 9.62% interest. I bonds are actually a pretty good way to diversify a chunk of your portfolio. 9.62% is a currently declared interest rate. Let's see what else about I bonds. You have to hold it for at least a year. If you cash it out prior to 5 years from now, you lose like 3 months interest. I bonds. Are you aware that I bonds, if your adjusted gross income or modified adjusted gross income is below a certain level, that when used for education purposes, that it's tax-free, as well as double E bonds, right? Well, what's Charlie talking about with the phase outs? Well, the phase outs are if you make too much money, too much adjusted gross income, or too much modified adjusted gross income, which the ideas here are to get that adjusted gross income down as low as possible, because so much relies on you having the clients having low adjusted gross income. But there are a couple of ideas there, right? What about the child tax? What about the child tax credit? Child tax credit this year is what, $2,000? Do they make too much money for that child tax credit, for instance? You know, that's about getting that adjusted gross income down. Now, this is where I talked about the very top box, right? Wages from W-2. When you look at that, wow, you have significant wages. Are there ways to reduce those wages, such as to put more into your 401k plan, into your pre-tax 401k plan? Some people might scoff at that. Why would they do it pre-tax today when tax rates are likely to increase? Well, that's the calculus, right? Maybe if they have a giant tax bill expected at the end of the year, it may make sense for them to contribute more to a 401k plan. So you look at that. If that's a large number, talk with them about contributing more to a 401k plan. And by the way, folks, as I go here, feel free to add your own ideas here. Taxable interest, what is that? Wow, you have a gazillion dollars, Mrs. Client, in taxable interest. Where is that money right now? Oh, it's in a certificate of deposit. Okay, it's in a certificate of deposit. What is that certificate of deposit yielding? Number one, I could probably get you more than that, 3.5% for 2 years guaranteed, or 4.3% for 5 years. Number two, that 1099 that feeds into this will not come when I put you in a tax deferred annuity that will pay you more interest than your certificate of deposit? Well, here's an area. Remember how I talked about qualified dividends versus ordinary dividends? Where's this money at? Is it safe? What kind of vehicle is that money in? Is it safe? Are there alternatives to where you're at right now? So that's line 3A and 3B. And you could see here that the far right column is where the far right column, well, I won't go into that. That could get into mental gymnastics big time. But they separate it out, right? Depending on the treatment of the taxes. Left column, tax exempt interest. If you look at 2A, right column, taxable interest. Then it goes down and you sum up all of that right column there. IRA distributions. Okay, so you've taken a distribution from an IRA. Maybe a chunk of that was after tax. Yes, you can have an IRA that is not all deductible IRA, right? Many people don't realize today, Bill Gates himself can contribute to a traditional IRA. Is it deductible or not? For Bill Gates, it's not deductible, but he can contribute to a traditional IRA. My friends that maybe make a lot of money, that's right, Form 8606, Dave. My friends that make a lot of money don't realize this. Well, Charlie, what would be the benefit though? If I want mutual funds, what would be the benefit of having a traditional IRA that's not deductible? Well, you don't get those capital gains distributions, right? It's tax deferred. No, it's not tax deductible. It's tax deferred. But when you cash out that after tax chunk of that IRA, you're not going to be taxed again, right? So that's why an IRA distribution is not necessarily all taxable. Well, the taxable amount goes over here. So the question is, required distributions as well. Required distributions, looky there. Well, are these for Mr. 75-year-old? All right, so these are required distributions coming out. You're required to do this. Do you need those required distributions? And that's maybe an opportunity to talk about qualified charitable distributions. What is a QCD? What is a QCD? A qualified charitable distribution is where instead of taking one's required minimum distribution in cash, what can happen is that required minimum distribution can go directly to a charity up to a maximum of $100,000. And what happens, let's say it's $100,000. What happens to that $100,000? So let's go back to this. That $100,000, my chart here above the line. What happens when we direct that $100,000 to the charity, directly to the charity? Well, but Charlie, charitable deductions, that's an itemized deduction. So that $100,000, I mean, or if it's $10,000, it's not going to make a difference. So let me ask you the question, what is the impact of that? Let's say $10,000 in a qualified charitable distribution. Is that $10,000 a deduction down here, or is it just something that was never included up here to begin with for that client? Is it a deduction down here, or is that QCD above the line? It's not even on the radar, right? It's not taxable. It's nothing because it's not a part of it of adjusted gross income. That's right. It's above the line. I wouldn't even call it an above. Technically, I don't know, I guess. It doesn't even hit the radar. It's above the line, that $100,000 in income. It never even happened. So it doesn't matter what type of deduction it is, because the end impact is the client's not taxed on that $100,000. So QCDs are a beautiful thing for those consumers that are charitable, that have a ton of money, that maybe don't want their required minimum distribution. Pension and annuities, that's pretty self-explanatory. If you're getting pension from an employer, that would go on line 5A. Wow, you're getting $1 gazillion from your pension plan. Tell me about that. Do you need all that money? Do you want to invest that money? Here's one of my favorites. Social Security benefit. Is it taxable? On the left-hand side, you will see, and this is fed in from the 1090 SSA 1099, if I remember right. Or is it 1099 SSA? my mind gets all twisted up with some of this stuff. But what's fed in there is how much is that Social Security benefit. But then over here, after the tax preparer does the worksheet, okay, Mrs. Client, you got $36,000. I'll plant the seed because we have a case study. $36,000 in Social Security, which will show up over here. How much of that $36,000 in Social Security is taxable? Well, it depends on what else is on this form and how much we could squish the rest that's on this form down, right? Any questions so far? Some of this stuff is fairly heavy, but I hope this is helping you kind of get some muscle memory when it comes to looking at this crazy form here, right? As well as what all feeds into it. We're going to come back to the Social Security one. Any questions, any comments, any concerns? Yes, great, thanks. Thank you, appreciate that. What is ATL? What is ATL? I don't know what ATL is. Feel free to clarify that, Sal. All right, now what about capital gains? So Schedule D, which another one of those forms feeding into it, the schedule that records short-term capital gains, long-term capital gains, that feeds into this. Whoa, above the line. Yes, absolutely. Or what some say is the calculations for AGI is above the line. The calculations from AGI is below the line. So you have AGI is the line. Subtractions for AGI is above the line. Subtractions from AGI is below the line. I learned that in my CFP thing. So capital gains, capital losses. You have a gazillion dollars, Mrs. Client, in capital loss or in capital gains, let's say. Where is that money? Is it safe? A little tidbit on capital gains. Many of you know this. Some of you can't talk about this a whole lot because maybe you're not securities licensed, but capital loss harvesting. This is what I'm doing kind of unfortunately with some of my clients is you have long-term capital gains, long-term capital losses. If you are taking capital losses this year, you can net out those capital gains. What happens if you net out to where you have so much in losses that say $10,000 goes beyond your long-term capital gains? So $10,000 net capital loss. What happens to that $10,000? Anybody know what happens to that $10,000 net capital loss? Does it get wasted? Does it get wasted? What happens to that $10,000 net capital loss? And you can educate your clients on this as well. You don't have to make security recommendations. But you can educate your clients on this. What happens is, well, first of all, you have short-term and long-term. Basically, those net out against each other. Those net out against each, short-term capital gains are netted with short-term capital losses. So those two calculations, long-term, short-term, and then if there's any left in any one of these buckets, the short-term and long-term nets against each other, right? But then when you have any, and I have a sheet on this that I put together for some of my folks. And then Alan, you know this, I know that you know this. If you have any left over, does it just carry over or is there also some other tax advantage? I'm going to wait for this one. Can you net capital gains, capital losses, or a net capital loss, I should say? Can you ever net it against income? Can you ever do that? Does nobody know this? I know that somebody knows this. I'm going to wait another 15 seconds. If nobody knows it, I'll tell you. By the way, folks, I do need to throw in the disclaimer. I'm not a tax advisor. I just play one on TV. No, I know my tax is pretty good. I'm a CFP, CLU, CHFC, all that good stuff, but it can offset $3,000 of income, right? Up to $3,000. So if you have any left over, say 10,000 bucks, $3,000 can offset your income for income tax purposes. Then what happens to the $7,000? Almost all of you got this one. That rolls forward into the future. It doesn't get wasted there. So how many advisors do you think are talking with their clients about this versus just getting a fee and just crossing their fingers, hoping the market's going to do good? You can bet that those clients that I have in my advisory accounts, which I do, I have a lot of 40-something-year-old clients that will do fine in the market. I'm differentiating myself from their Edward Jones advisor, for example, nothing against them. I'm differentiating myself by saying, hey, there's a capital loss here. Why don't we take that capital loss? But hey, but Charlie, yes, I have a capital loss in Ford, but I don't want to cash out of the auto industry. Can I just take money out of Ford, for example, and then purchase it back the day after? Can I do that and still get that capital loss to offset my income? Folks, can he do that? Can he do that? So get that capital loss. Today, I'm going to cash out of Ford because it sucked really bad. It's down to like 10, 11 bucks a share. What if he cashes out and buys it back today? Can he do that? No, he cannot. Why? Because of something called the wash rule. The wash rule. He has to basically be cashed out for 30 days and then he can buy it back. Otherwise, the capital loss, it's just not recognized. So the IRS is ahead of us. Congress is ahead of us on that. That's called the wash rule. Now, here's a tip for the advisors. Then we're going to move on to the not just advisor stuff. Can he cash out a Ford today and buy GM? So the entire auto market is down. He still wants that exposure. Can he cash out a Ford and buy GM? For instance, just as an example. Yes, absolutely. So there are ways, Chris, and I spoke with my attorney about this because substantially equal rule and all that. So Chris had said no. Now, if it's cashing out of one mutual fund and going into another substantially equal, maybe a different share class or something, you can't do that. You can't do that. Why not just buy a Ford option, not the stock? You could do that. But yes, you can switch companies. That is not substantially equal. Congress has said, well, you can't cash out and go back into the same thing, or even something that is substantially identical to it. Ford and GM are not an example of that. So my attorney says, but consult with your attorney there. So there are ways around the wash rule there, kind of. All right, so other income from Schedule 1. If you remember Schedule 1, it's divided into income, Schedule C, Schedule F, farm, Schedule E, real estate, for example. That's income that gets fed in here. For many of you, this chunk, look at your tax return. By the way, all of you, if you're learning stuff that you didn't know, should get off the phone, pull up your tax return, and you'll see this stuff. You will see that if you are like an LLC, for instance, a sole proprietor, you will see that there's a big number in here, or a partnership or what have you. There's a big number in here, right? With mine, that's the big number. Why is that? Because Schedule 1 had the Schedule C flowing into it, which is profit or loss. I'm happy to say that I have pretty good profit, right? So that feeds into there. Well, tell me about your business, sir. Does your business have, actually, I'll move ahead here, because also on Schedule 1, does your business have an IRA, a simple? Does it have a SEP IRA? Do you have a SEP IRA through your business? All right, you own a business. I see that with a Schedule C, which you don't have to look at Schedule C. You would know if he or she owns a business. What about the long-term care deduction there, right? So what we're able to do is we're able to minimize all of the numbers up here by looking at Schedule 1, that second half of Schedule 1, and trying to maximize that Schedule 1. I like the 1040. I like the Schedule 1 because the Schedule 1 has all of the fun stuff like IRAs. Are you contributing to an IRA? Are you contributing to a simple? Are you contributing to a SEP? What about long-term care deductions or employer health insurance deductions that would go into that? That's a good thing, right? And again, that is all above the line being this. Number 11 is the line. Number 11 is the line, and that is adjusted gross income. So all of this that I talked about here takes place above the line. Everything below the line is it standard deduction, which is most people today, or is it itemized deductions? But then you can see there, once they have the adjusted gross income, it's either, hey, you deduct the standard deduction, which is, you see these numbers over here, around $28,700 for a couple age 65 or older, or from Schedule A, that's where you go over all the itemized deductions. If it's bigger than that 28,000 some dollars, because you have a lot of health expenses, for example, home mortgage, real estate taxes, all of that other fun stuff. Most people do not itemize today. And that's when it gets into the calculation of taxable income, which is how, I'm going to go back here, which is how I started the conversation, right? Let's go back. The end result is, come on. All right, let's do it this way. Let's do previous. You know what? I'm not going to go back there. You know what the tax brackets look like. So it goes back to that. Now, Charlie, you mentioned something about the above the line for self-employed and long-term care. You mentioned that there were maximums. Yeah, this year's maximums. So for our client that's 60 to 70, for example, and owns his business, for example, what can he deduct? What flows through that Schedule 1 above the line from a deduction standpoint? Everything up to $4,510 in this example. That 7.5% of adjusted gross income, it doesn't apply, right? Because that's down in the itemization area. Because he's a business owner up here, that is actually a business expense, which flows through that Schedule 1. Am I making sense, folks? Am I making sense so far? So that's an opportunity for your self-employed folks there. Am I making sense so far? Then we're going to move on to Social Security taxation real quick. Are you guys getting anything out of this, or is it a little too much? Is it a little too much, or are you getting something out of this? No comments there. We'll see. So the Social Security amount over here, Social Security taxation on them. Well, good. I'm glad you're getting something out of it. Good stuff. I appreciate it. Great. Good stuff. Good. All right. This is a little unique. I've never done this one before. It is more complicated. How do you take 75,000 pages of tax code, distill it down? Not that I know all 75,000 pages, but all right. So Social Security shows up here. How, Charlie, does Social Security show up in this column, and what number is it versus just the benefit over here in our good column, which means no Social Security taxation? What Social Security is about, and all this is kind of a circular formula, right? So you get down here to adjusted gross income. Social Security is taxable if you have a ton of adjusted gross income. So it's kind of a circular formula in a way. But just know that the goal is, to minimize this stuff up here so that your AGI, the line, so that the line, the AGI, is as low as possible. Because what determines Social Security taxation is, I should have put AGI in there. Technically, it's modified adjusted gross income, which I'm not going to go into. But so their gross income, call it AGI for these purposes, adjusted gross income plus 50% of their Social Security benefits plus non-taxable interest. So back here, remember how I talked about the two different columns here? This is the good column. Those muni bonds, they're a beautiful thing, right? All that interest right there in muni bonds, it doesn't show up in that column there. And this column is the one that's summed up for purposes of the final tax calculation. Well, when does this little box come back? When it comes to calculating provisional income. And Social Security is taxable when provisional income is over these amounts right here. So if you're married, let's use the old good, reliable married filing jointly. So if your provisional income, which is this that I just showed you, that calculation there, where that non-taxable interest is actually added into this formula, then they could have as much as 85% of their Social Security taxable, right? Married filing jointly, 50% of their Social Security plus municipal bond interest plus modified adjusted gross income, if they're over 44,000, it's not, it will be 85% taxable. It probably will be. Now for those geeks, and this is pretty simple actually, what is the calculation? What is the calculation for? Is it or is it not going to be 85% taxable, Charlie? Here's a calculation, case study. We have a couple that has AGI, so adjusted gross income of $60,000. Why do they have that adjusted gross income? What adds to that adjusted gross income? Remember that little column back here? IRA distributions, taxable amount. This goes towards the adjusted gross income. So they don't have any IUL. They don't have any Roth IRAs. Hint, hint, Roth conversions. They just have all traditional IRAs. So I very purposely worded this. So, okay, so they have $60,000 that's in that right column there that's beefing up their adjusted gross income. In addition to that, he gets $2,000 a month Social Security. She gets $1,000 a month, 50% of his, right? Social Security seminar. If you listen to that, you know why she gets 50% of his. So that's $36,000 a year between the two of them, but plus municipal bond interest. So, okay, what's the calculation? Well, adjusted gross income here, again, $60,000. Half of their Social Security, which is $36,000, that's $18,000, right? Plus municipal bond interest. You can see I intentionally tried to make these numbers easy. That's $80,000, which is $36,000 above the $44,000 taxation threshold, right? That I showed you here. Okay, so then does that mean it's 85% taxed? We don't know yet. Here's the calculation, and it's easy. So the marginal thing, right? I talked about marginal at the beginning. So their provisional income, which they have 80,000 of, right? The first 32,000, zero taxes. The 32,000 to 44,000, 50% of that is taxable. So that's $6,000, 50% of 12,000. But then 44,000 to 80,000, 44,000 to 80,000, 85% of that. So what is that? 36,000, 85% of that is 30,600. So does that mean that when you sum all these up, that $36,600 is how much their Social Security, how much of their Social Security is taxed? No, because they only have $36,000 in Social Security. Okay, then it's the lesser of these two, this calculation here, or 85% of $36,000. So in this case, $30,600 is added in that right column. Going to go back here again real quick. Is added in this column over here. When you see this column having something in it, that's when you should have a talk with your client. There are probably opportunities to maximize. This column, I also like. Taxable interest. They probably have certificates of deposit. Qualified dividends. I like all of these columns right here, actually. Oh, then capital gains down here. Capital gains. Where is your money? Is it safe, right? That is the calculation. Alan K. So yeah, talking about spousal benefits. That's right. So that's calculation. So all of this, whether it's SEP contributions, simple contributions, IRA deductions, what else? Roth IRAs, repositioning maybe qualified money today into something that's tax-free eventually. What does that do? It reduces the line, right? It reduces that adjusted gross income number. And when you have less of an adjusted gross income number, you have less Social Security taxation. You have, okay, well, now can they deduct their IRA contributions, right? Because remember, if you have income, modified adjusted gross income above a certain level, you can't do that. Bill Gates could put into a traditional IRA, but he can't deduct it because he is above that. Shrink Bill Gates' adjusted and modified adjusted gross income number down. That'd be a big task to get down to, what is it? The IRA to be fully deductible is $109,000 for married filing jointly. Can they deduct tuition? So tuition, we're getting into the itemized deductions, right? Double E&I bonds, for example. I talked about if they are itemizing deductions, what about those health expenses? If you get that AGI down, it's easier to get over 7.5%. Education credits. You know, if I go back to college for whatever reason, if my AGI was low enough, I could have a good chunk of my education paid for via credits, right? Shrink that adjusted gross income down. The child tax credit, which was pretty prominent in the news last year, it was beefed up, but this year it's going back to $2,000 per child. When somebody points at their kid and says, that's my tax write-off there, it's a joke, yes, but there's some truth to it, you know, up to $2,000 per child. If your child is getting dependent care, if they're under, I want to say 13 years old, if I remember right, you can have expenses of up to $6,000. You could have it's a credit, but yet it's treated like a deduction, which I won't go into. Again, shrink. The point to all of these is shrink that AGI, the modified adjusted gross income down. Folks, in the senior market, IRMA, income related monthly adjustment amount. Look at this. Look at the power of not having a low adjusted gross income. I'm getting towards the end here. What if you have adjusted gross income of above? My lady, right? My lady who sold the house for $500,000, well, 750 grand, of which $500,000 is taxable to her as capital gains. Do you think that's going to hurt her a couple years from now? Absolutely. What are we looking at? She's going to be paying almost $600 per month in Medicare Part B expenses. Medicare Part B for the normal mortals on this planet, $170 per month. Look at the difference how when she makes a ton of money because of that house sale, for instance, what happens there? Folks, please fill out the evaluation. If you're not appointed with CG Financial Group, get appointed with CG Financial Group. These webinars, I think you would agree, they're different than the cookie cutter product webinars. I'm about your development. I'm not just about you selling products, so to speak. So please, number one, get appointed with CG Financial Group. We have like 120 annuity, life, and long-term care companies. You'll never be out product when it comes to working with us. And again, fill out the evaluation. Thank you very much for your time. It was a meaty webinar. I hope you were able to capture a lot of it, however. Thank you, folks, and have a good day.